everybody. Welcome to the Fundamental Analysis webinar here with AvaTrade. My name is Troy. I'll be presenting. As we get started, let's do a quick systems check. If you would, type OK in the question box if you're hearing me clearly and seeing my screen all right. Okay, it looks like we're up and running fine. If anyone has any issues as we go along, feel free to let me know. As always, keep in mind that there's risk involved with each trade that you take. No one trade is guaranteed to profit, so you want to manage risk in a way that makes sense for you. And we'll go over some ideas in that regard with some of our simulated trades within the session. We have some tools that assist with risk management quite a bit within the order window to make it simpler for you. Also keep in mind that what we cover is not meant to be financial advisement, but is coming from an educational perspective. Real quick before we get on the live charts and look at the news that's coming in, what is fundamental analysis? For anyone who's new to things, basically that's looking at different types of news and information that's coming in from around the world that might clue you in on which way maybe the wind is blowing, so to speak, with the price movements on certain instruments. And so, one of the more readily available bits of information to look at, fundamentally speaking, would be the economic calendar. These are regularly scheduled events. We know what they'll be about. If it's a speaker, we know who will be speaking. We know the exact time, the exact day, etc. And we can, with the use of our advanced features on our economic calendar within our WebTrader and app, we can look back at the past announcements. What did the movements look like based on how the announcements came in the past to come up with some idea about projecting, maybe based on the current announcements, what type of trade might make sense, statistically speaking anyways, from the past movements. And so we'll do that today. There are a number of economic announcements that are really key announcements that have produced quite predictable movements in the past. We'll see the statistics on that using the analysis tools. And also tomorrow, some really big announcements coming in. So we have a number of announcements we can look at. We'll look at a handful of them, some of the more key announcements. And there are other types of fundamental news as well. The extraordinary type of headline that might come in, unexpected news events, stuff that's not scheduled. And as those come in, we consider those as well within our fundamental analysis before we decide how we might want to trade on something. For example, if the war and fighting that's going on in the Middle East right now were to spread and get worse, maybe that creates supply disruption fears for something like crude oil, and that type of fundamental news can then clue you in as to what direction you might trade on that particular instrument. And that's just one example. When the pandemic hit, or when Brexit was happening, any number of things in the past. Also, we had unexpected headlines that caused market movements in different directions depending on what the story was about. And so those types of news events we need to pay attention to as well. As we go along, if you have any questions, you want to give any input, feel free to do so at any time in the question chat box. From our main website, if you don't have our AvaTrade Go mobile app yet, you should download it, as well as the MetaTrader app as a backup. It's nice to have a couple different ways to log into your account, but when using the AvaTrade Go mobile app, you'll see the same functionalities and extra tools that you'll see in today's session in the WebTrader. Okay, so the same items are there, and you can find our app just by keyword searching, or it's here on our website under our platform section. And then there's a link from our website to the major app stores to download the AvaTrade Go mobile app from the Google Play App Store or the Apple App Store. And so let's go ahead and log into the WebTrader. By logging in the upper right corner of our website, you'll be in the WebTrader. And so let's jump right into some fundamental analysis. And so first, I think we should start on the economic calendar. And we'll take a look at what's happening today and tomorrow, and how you might be able to work some strategies around those fundamental news events. And so a number of announcements have already come in today. We'll kind of to bypass those and look at what's coming up in the near future. And so European Central Bank interest rate decision coming up. And so we can take a look and say the expectation is that it'll stay the same. This column shows the last rate decision, 4.5%. The expected is 4.5%. And then when the announcement comes, we'll see what rate decision was it actually. Okay. And so, you can speculate all you want. If this comes in higher than expected, maybe that would be bullish for the currency. If unexpected rate hike comes, that in general tends to strengthen currencies. If they unexpectedly lowered the interest rate, then that tends to weaken a currency. So, anything unexpected in one direction or another, we can speculate as to what would happen. We also could say, well, if it comes in as expected, maybe there's not much movement at all. But we don't have to guess about that. What we can do is use these tools to see, well, what has happened in the past under these different conditions. And so we could pick which currency pair we want. Euro USD is popular. We could pick the time frame after the announcements that we want to analyze. And I suggest you analyze multiple time frames. We'll start on the 4 hours after. And you can look at all the events or qualify them, the ones that came in above forecast or below forecast. When it comes to rate decisions, the vast majority of the time they come in as expected. Okay, so indeed, if we look above forecast, how many came in the past year or so higher than expected? None. Okay, how many came in below forecast? None. That's not the case with unemployment rates and jobs numbers and CPI data and all of that. Those tend to not come in exactly as expected a lot of times. But the rate decisions, most of the time, come in as expected. And so that's the only data we can analyze, is if it comes in as expected again, if it matches the forecast, what has been the reaction of the market. And what we see is 2/3 of the time almost, the euro has weakened against the USD, okay, with around 86 pips movement, okay? So, 3 times it went up, and 1, 2, 3, 4, 5 times it went down, all right? So you can make what you will of that. It's not the same as being able to check above forecast or below forecast, but it is data, and you can see the type of range movement you might expect in the 4 hours following the event, and the directionality. If it comes in as expected, 2/3 of the time you'd have been a winner if you were selling, okay? And after 4 hours, we're talking over 86 pip movement. In the first, let's say 5 minutes, we're looking at only about 20 pips movement with 50-50 directionality. So half the time it even went up in the first 5 minutes. But after 4 hours, 63% of the time, they came back down, okay? So in actuality, if you wait the first 5 minutes, in many of these instances, you actually got a better entry point to then sell in the direction that you expect 2/3 of the time it would be after 4 hours, okay? And those that did drop in the first 5 minutes, the average range movement's only 20 pips, okay? We see it down here. And after 4 hours, the average range movement has gone to 86 pips, okay? Only 1 or 2 of them ended up at 13 pips. The rest of them were well past the distance that it was at after 5 minutes, looking at 40 pips, 50 pips, 60 pips, and 86 pips. This one actually went 132 pips. Here, okay? So it looks like a distinct statistical advantage if this comes in as expected today to, in the first 5 minutes, see if you can catch an entry point that hasn't gone a significant distance of this expected average true range, or that maybe even spiked up, and see if you can take a shot at being right with these statistics, okay? And, you don't put everything on it necessarily, right? You have a certain percent risk you take on each trade if you're risk managing, and you're not necessarily going to win every time. But if you do this over the course of weeks and months, this type of strategy on different announcements, you might find that you do work out with statistics maybe somewhere near what we see here. And if that's the case, depending on your entry and exit point, you really could have quite a profitable system. Okay? That's just the rate decision. What else is today? We have initial jobless claims out of the US. And you notice I'm looking at the high volatility announcements, not necessarily, certainly not the low, but even sometimes the medium I'll look at. But for sure, we like to look at the high volatility ones because there's a bigger reaction typically on the charts. Okay? Okay, so initial jobless claims out of the US. Let's look at this volatility tool. Euro USD is fine for me. We could look, I've noticed GBP USD has larger movements when you analyze the data. Like Euro USD after 4 hours is about 48 pips. GBP USD I suspect is larger, 58 pips. Okay, larger movement. But I also have noticed that the predictability seems to be a little bit better on Euro USD and a little less on GBP USD. So greater potential profit, larger movements on the GBP USD, but the percentages from what I've found, and you can search around the different pairings to see for yourself, but the percentages, the predictability seems to be a little better with Euro USD, even though the range movement is a little smaller. Okay, a little less volatile, maybe a little more predictable. So right now we're looking at all events. So regardless of whether these come in above expectation or below expectation, 2/3 of the time when there is an announcement on initial jobless claims, the USD has strengthened and pulled the euro down, regardless of how they came in. Now, I don't like looking at it that way. I want to qualify it and say, okay, if it comes in above forecast, now that's more significant. 75% of the time, the USD has pulled the euro down, and we're talking a range movement of over 60 pips, 62 pips here. 75% of the time drop. So if these numbers come in above forecast, in the first 5 minutes, the movements all went up. Look at that. First 5 minutes, everything went up with a range movement of near 10 pips upward. Okay? If you had placed those trades on when these numbers came in above forecast within the first 5 minutes, look after 4 hours, what happened? 3 of them went flying down and only 1 would have been a loser. And it wouldn't have lost by much because you would have already started from that high point. So these are the sort of strategies and concepts that you can put together based on past data. Okay? It's called data-driven trading. I'm not guessing. I'm going on the statistics. And I know 25% of the time in the past I would have been wrong, and 75% I would have been right. Okay? Now, that doesn't mean that will continue in the future, but this is how we use data-driven trading to try and gain a statistical advantage. We see there's a relationship statistically that when this comes in above forecast, the USD strengthens. Okay? What if it comes in below forecast? Still downward movement, but less of a statistical advantage. Not 75%, 63%. And also, look at how much upward movement some of these did. Look at the size of that movement. The largest movement is actually up, even though the statistical advantage is down. That's kind of a red flag for me in the statistics, okay? There were better statistics and better, more consistent downward movement when it's above forecast in the past. Okay, only one that went up, and the one that went up was not any larger than the ones that went down. Whereas in the below forecast reading, 3 of them went up, and the largest movement was actually up and not down, not in the direction of the statistical advantage. Okay, so on this one, I might choose only if it came in above forecast, maybe if I like the entry point in the first 5 minutes to go in the direction of the statistical probability. Okay, and I'm just breaking it down how I would look at it. You can read the statistics however you wish. Now, what else is there? If we go on to tomorrow, and there's another testimony, there's something else we could look at. Powell is speaking again, Fed Chair Powell in the US. He helps make monetary decisions about interest rates and other things in the US. What he says has moved the markets a lot. So if he spoke yesterday and he kind of alluded to the fact that they are kind of starting to realize that they're going to maybe have multiple rate decreases this year. And the markets like that. We saw the stocks go flying up when he was saying that. The stock market likes low interest rates. So if he's alluding to the fact that they could lower interest rates sooner rather than later, it's a positive response. USD maybe weakens and the stocks and equities go up. Now, what is he going to say today? He could come out and say the opposite, right? We don't know. So it's harder to trade on these types of announcements because there are no numbers. It's what is he saying, right? And you'd have to sit and listen to what he says to decide which way you think the movement will go. So these are a little bit harder to use with this tool, okay? Now let's go to tomorrow. And there are a couple that I think stand out. The industrial production out of Germany, that's a big deal. That announcement tends to make big movements. If we look, same thing, Euro USD, 4 hours after the event. If this comes in above forecast, it's 50-50. Okay, one time it went down, not much, went down a little, and went up a lot. So it looks like an advantage to buy rather than sell. It only happened twice. The time that it went down, it barely dropped at all. You can almost not see any movement in this area here. And when it went up a lot. Okay, but what about in the opposite direction? If it comes in below forecast, now we see a big difference, a big turnaround. There's a lot more red going down than green going up. The market flipped if this comes in below forecast. 2/3 of the time, the USD pulls the euro down if industrial production comes in below forecast. And that might make sense in your mind too. You know, weak production numbers, then weakening euro. So it makes sense in my mind that there'd be more downward movement. And if you can catch a good entry point before it gets near this 26, 27 pip range movement that would be expected from the past, then maybe you sell on this. It's not a 50 pip movement. It's not an 80 pip movement like some of the other announcements, but it does look like a pretty good statistical probability in terms of predictability. Okay. What else can we look at? The PPI data is coming in at the same time, so you can analyze that and see if this comes in above forecast. Wow, this looks a lot more predictable. So the industrial production has some predictability to it, but boy, if the PPI data comes in above forecast, the euro climbs 80% of the time. And the one time it dropped, it barely dropped compared to how much these went up. This one I like better, okay? Higher percent predictability, larger movements, 35, 36 pips rather than 20 something, and the predictability is at 80% based on how it might come in. What if it comes in below forecast? 2/3 of the time dropping. So you see a direct relationship here. Below forecast, euro drops 2/3 of the time. Above forecast, it goes up 80% of the time in the past. Okay, so this one I might key on because I could trade in either direction, and more preferably, I would be hoping it comes in above forecast and maybe look for an entry point to buy, okay, based on those past statistics. So this is what you can do each weekend. Go through the coming week's announcements, go through the announcements that are maybe high volatility, the ones you think are most important, and find the ones that look like they have the best statistical predictability from the past, and write down your schedule of which ones you plan to trade on if they come in above forecast or below forecast, etc. Okay, some of them you might trade in either direction depending on how they come in. Some you might say, well, I only prefer on this PPI data if it comes in above expectation to buy. If it comes in below, the predictability was less and I won't make a move, as an example. So you have your plan in advance, and then it's a simple strategy then to carry it out as you watch those numbers come in through the week for the ones that fit your schedule to be able to be in front of your computer or your trading app when that happens, okay? Others we could look at. I'm not going to take the time to look at every one of these. We've got out of the US, huge announcement each month is the non-farm payroll announcement. It's once a month. It's the major jobs announcement numbers out of the US. And so it's tomorrow, non-farm payroll. So look at the drop in jobs numbers that's expected. That in and of itself gives you some idea about what the market expects. From 353,000 new jobs created the expectation is it's going to drop off like a cliff to under 200,000 new jobs. So 195,000 as opposed to what it was last month, 353,000. So already that feels like, wow, that feels like negative sentiment there. What if this comes in even lower? Or what if it comes in way higher, up, towards 300,000 again? It could happen. I've seen these numbers be way off in the past in terms of what's predicted and what they come in. It almost never is the exact number. Okay, it's hard for it to land on the exact number that's predicted. So I can tell you this, the advanced data that came out earlier this week came in below expectation. So the expectation was low, and it came in even below that. Okay, so let's take a look then and see what has happened in the past with this. So again, we can leave Euro USD, you could put GBP USD, USD JPY, whichever currency you prefer. And you can check the different pairings because they'll have different percent probabilities from the past. You can find the one you like best. For time's sake, I'm just sticking to the Euro USD for this session. Now, 4 hours after the event, and if this comes in above forecast, 50-50. Okay, so if the jobs are better than expected, it's anyone's guess which way it'll go in the 4 hours that after the event. Half the time it was up, half the time it was down, exactly half, 50-50. If this comes in below forecast, wow, look at the difference in terms of predictability. The market is just waiting for the US inflation to slow down so interest rates can come down. And so if these job data comes in not only as low as they're expecting, which it's already an expectation of a large drop, but if it comes in even below that, there could be a rapid movement on the charts with Euro USD with the realization that, wow, things are really slowing down if the jobs numbers are that bad. And you could see a weakening of the USD with more of an expectation that the US could start to lower interest rates if things are really starting to be that bad in the US. Because the idea was they're not going to lower these interest rates back down in the US until inflation comes down. They increased interest rates 10, 11 times in the past year plus to bring inflation down. And so until they see key indicators in the US that things are slowing down, that the economy is actually starting to get a little worse maybe, they're not comfortable to lower interest rates yet. But if data comes in on jobs, not just lower as it's expected, but even lower than the expectation, if it comes in below the forecast, that gives excitement maybe to the market that, hey, they're more likely to lower interest rates now in the US. And when you lower interest rates on a currency, that tends to be bearish for the currency, makes it cheaper to get. You can take loans for less interest. So it's cheaper to get your hands on the money. The money becomes less expensive with lower interest rates. And so that tends to cause a bearish movement for that currency, which is why maybe you see 75% of the time a large climb on the Euro USD if these numbers come in below forecast, if the jobs numbers show a larger slowdown than expected. Okay, now I'm going through the why, right, in my mind, trying to understand why it happened. And that's what that explanation's about. But really with data-driven trading, you don't even have to do that. You just look at the data. I like to see that the data makes sense for how I understand why it happened. But true data-driven trading, you don't even care about that. You just look and you say, if this comes in below forecast, there's a large movement up 75% of the time. And the one time that it didn't go up, it barely dropped. So this is really convincing data to say if this comes in below forecast, if in the first 5 minutes it hasn't moved towards this 73 pip range movement, or if it's gone the opposite direction, if I was seeing this one or any of these, they haven't gone past 27 pip range movement, it looks like those are all good entry points in those first 5 minutes. And even this one that ended up down, if you got in the first 5 minutes, it was down less than that, and they all would have won after 4 hours. Okay, so this is the sort of data that can be very powerful. You're not going to win every time. At some point, it goes against the statistics, but this one looks pretty convincing. It's one that if I was going to trade on this tomorrow, I would be hoping this comes in below forecast and then try and get the entry point that is before it gets significantly towards this 73 pips upward movement. Okay, you see this one was 84 pips, this one was 90 pips, and this one was 82 pips. So they're all well above this range movement because this one threw the statistics off. This one moved a lot less. But the ones that moved went 80, 90 pips up. So if it's gone 20 pips and you could get the trade off and it had come in below forecast, then you could get your stop loss back below a certain distance, 20, 30 pips down, and have a 50 pip take profit and still be within this range. Okay? And see if it hits that take profit in the first 4 hours. That's just an example of how I'm using this data to not only figure directionality, but also distance to my stop loss and take profit based on the expected true range movement that they show here. This is the average true range. Okay? It's a actual reading. Okay? So this is something that is really powerful data, and you can pick not just directionality, but distances off of this type of movement. Okay, and that's the non-farm payroll data. I expected to see pretty powerful statistics from it because it's so heavily traded, and that's what we saw there. Okay, we also could look at the other announcements, average hourly earnings. Now it's a medium level announcement, but there's been a lot of focus on earnings in the US because if people are making less money, then that's going to increase the likelihood that inflation comes down. If they keep making more money, that hurts inflation. It keeps it up. So we can look at the same time and say, if these numbers come in below forecast also, there's also a statistical advantage that the euro climbs. So then that's a doubling effect, okay, an additive effect. That statistically speaking, if the non-farm payroll is lower than expected, and then also the hourly earnings are lower than expected, they both have a statistical advantage to buy on the Euro USD. Okay, and if this came in above forecast, it's a little less statistical advantage. But you see, this one has less effect. Both times, no matter how this came in, it went up. Why? Because the non-farm payroll is being looked at more. So this one's kind of blowing in the wind, and the statistics are less convincing because the focus is more on the larger announcement, the non-farm payroll, which seems to be driving the movement more than these announcements here. And that's why the statistics look stronger on this one compared to the hourly earnings. Not that the hourly earnings aren't important, but maybe to add them together and say if they're both below expectation, then you really would make the move. That could be smart as well. All right, so and there's Canadian announcements as well. We don't have to take the time. It's the same process, the same strategy idea to look at those. Any questions, comments before we leave the economic calendar in this session? Okay, I see some good questions coming in. Tobo, you're asking, can you use this type of strategy on short-term trades? Absolutely. I'm looking at a 4-hour window here. So in fact, the longest time frame that this analysis from the calendar shows you is maximum 4 hours. So that is short-term trading. And you can analyze it in 15 minutes, 30 minutes. Yeah, so let's look. Let me show you. So non-farm payrolls, let's go back to it. We looked at it. If it's below forecast after 4 hours, it's 75% of the time it goes up. In 15 minutes, 75% of the time it's up. Okay, so you could be doing a shorter term trade, but in the first 15 minutes, it went 40 pips. You see, 40 pips. In the first 5 minutes, it went 27 pips. So it takes you a couple minutes to get the trade off, right? Or a few seconds, depending how quick you are to make your decision. So in the first minute or two, if it moves 20 pips and you're short-term trading and you expect to get out after 15 minutes, it's only another 13 pips on average that it moved in the next 13 minutes. So I'm trying to show time frames that show entry point and exit point a little bit further distance apart. It's still short-term trading, but in the first 5 minutes, the average range movement was only 27 pips. And if you wait at least an hour, now the range movement is 52 pips. And if you wait 4 hours, the range movement is 73 pips, okay? So all of that is short-term trading. You certainly could do it from 5 minutes to 15, from 5 to 30, from 5 to 1 hour. I like the 5-minute look, and then judging whether I want to trade that through the 4-hour window, because the range movement on large announcements tends to end up further and further in the right direction if that's the way it's carrying. Okay, you're asking, Carolee, how long do you look back to establish the baseline of change? This is looking back over the past year or so of announcements. Okay, you can see the dates: February, December, October, August, June. This is April of last year. So this is about 1 year worth of data. Okay, and probably you wouldn't want to look back much further than 1 year anyways. The tool doesn't give that option. But if you start looking back further than 1 year or 2 years, you're in a completely different market circumstance. The interest rates weren't raised then. We didn't have an inflation problem if we look back 2 years, 3 years worth of data. And so it becomes less and less relevant to the current market conditions if you look at too much data too far back. Okay, so I think it's actually a more powerful tool, the fact that it's only analyzing the past 1 year or so worth of data. Very good question. Okay, the question is the market open in a certain market, whether it's the London Open, the New York Open, is that considered a fundamental event? And I would say no, it's not fundamental news when the market opens or when the market closes in different regions, but you are correct. There are different trading strategies that you can use. Some people only trade the London Open. Some people only trade the New York Open, meaning when the market first opens, because they've worked strategies around what they see statistically in the past tends to happen right in the first maybe half hour or hour after the market opens. Okay, and I know just from my experience, the volatility tends to jump. The trading volume tends to go up when the market opens in the US or when the market opens in London. You tend to have a bit more volatility, some larger movements on the charts, and so you'd want a trading strategy that tries to take advantage of that volatility and those larger movements, rather than when you're trading during off-market hours. You have strategies that maybe do better with a lower volume of trading, with less volatility. Okay, and with less volatility, the movements tend to be smaller and slower. Okay, and with more volatility, right at the US Open or London Open, etc., Australian Open, depending on what you're trading, you tend to have more volatility. You tend to have some surges and movements that go up and back down or down and back up. And you could try and take advantage of that less predictable, higher volatility type situation. Very good question. That's not directly fundamental analysis. It's more technical analysis based on time of day and volume of trading. Very good question, though. All right, so let's maybe look at one more tool that we offer. We've got a news feed here. We won't get into it too much. News feed, it takes anything that's happened today, announcements that already came in, headlines that hit, and summarizes it for you and suggests what you might trade on based on that summary. Okay, this is something where if you don't want to take the time to look at the calendar, to read the articles, etc., here's a summary. Okay, I tend to want to read the whole article myself or look at the announcement and analyze the calendar like we just did myself to get the statistics down, etc. But this is a time saver, and it's a summary of what's happened for different market areas. Okay, crude oil. Here's crude oil. Here's a summary about crude oil and what might affect it today. What maybe already happened or didn't happen. And sometimes you read these and you say, wow, I want to make a move on that. That sounds convincing. And other times you read it and you say, well, it doesn't really tell me much. And so, but it's useful to use and it can save a lot of time. The market buzz is a little more targeted. You can pick what's trending the most or not from the bubble gram. The larger the circle, the more it's trending. All of a sudden I see something pop up that I'm not used to seeing. A larger size circle here, the New York Community Bank. So that catches my eye. I'm used to seeing Tesla and Apple and Nvidia, Microsoft. They're always trending the most. It doesn't mean anything special is happening. There might be, and you can look and check and see, but I bet something special is happening with this one, because boy, that's a smaller type regional bank and a community bank in New York. And why is it trending so much? So now I'm going to click on it. It might have my interest now. So I click on it and I see price may rise 76%. Is that, you start to think, is that a typo? 76%. What in the world's going on here? You can start to read the articles about it and see why would it rise 76% right now. Okay, New York City Bank shares plunge 42% before rebound on $1 billion capital raise. So if you read this article, click on the link, story continues, click that. You can read about what's going on with the New York Community Bank. And what happened was they were in financial problems. And people found out about it and sold the shares like crazy. It dropped 42% even further. Okay? Then they got a bailout offer, $1 billion of capital they raised to be able to continue to function. So now the expectation is it could go back up a huge amount from what it dropped. Okay, so now you can read the story and understand, do I want to trade on that or not? You never would have known about that without this tool, maybe. And so you can go on. Morgan Stanley cuts New York Community Bank Corp stock target to $4. Okay, Morgan Stanley saying their target is $4. Okay, take a look. Where's the price when it opens? Is it below $4 a share? Above? Okay, did it drop to $1? Is it at $7? So you can start to read the articles and understand, what do others think about this from different sources. And these aren't like, Joe Schmo on Facebook saying, hey, I think this or that. Morgan Stanley's pretty respected. All right. This is information about a huge capital raise, $1 billion. And so you start to put together this information. Former Treasury Secretary of State leads $1 billion rescue for troubled New York bank. It may or may not be something you're interested in because it sounds really volatile, but maybe you take a small chance at it because it is maybe more risky, but wow, look at the potential rise that they're predicting. All right, we see the gap down, the continued dropping and dropping. If you think the bailout could bring it back up to its original price, okay, it closed at $3.46. Okay, Morgan Stanley thinks it could go back up to $4. That's a pretty big percent movement from $3.46 to $4. Sounds like a small amount, like 54 cents. But when you're talking only $3.46, 54 cents rise is a huge percent gain. Okay, so if you can get a spot that you like somewhere before these potential take profit suggestions up around $5 or so, Morgan Stanley says $4, then maybe it's a move you make. You notice they're not predicting that it'll go back up from where it gapped down to because they still have some financial problems, right? Just because they got a bailout doesn't mean they don't still have financial problems. And clearly it was way above even $5 before the huge sell-off, okay? So very powerful tools. You've got the technical analysis for you. You've got the fundamental news to make decisions in an informed way without someone else just telling you, hey, buy on this or sell on that. The technical signals that come in, great. I can click on the technical signal and it can tell me what they think will happen. But I'm also going to check the fundamental news and see if it agrees with that direction. And if it does, then maybe I follow the signal. And if the fundamental news in the last few hours in the market buzz shows articles that work against this signal, then maybe the signal's old and the news is new, and I don't trust the signal anymore, okay? So don't blindly follow signals. At least I don't think you should. I think you should check the fundamental analysis as much as you can and use the signals as a supportive tool. They break down the technical analysis really well within the signals. As a supportive tool to reassure you that maybe your read of the fundamental news is good. And then if the signal is in the same direction, then maybe that's on your checklist to then go ahead and make a move. Okay. Kevin, thank you. I'm glad you're enjoying the session. I think this is a spot where I'll stop. We've been going for over 40 minutes. I know that people tend to lose focus after 40 minutes, and we've covered quite a bit of information. So the session is recorded. All of our sessions are. So by tomorrow, this session will be on our YouTube channel. You'll find it there with my other recorded sessions as well as other presenters' sessions. Okay, there's a section specifically for English presentations, English webinars. But that's it. I think we'll stop here. Good luck with your trading. There's a lot of fundamental news you can trade on today and tomorrow. Any last questions, comments before I end things? Okay, everybody, you're welcome, and thank you for attending. Good luck with your trading. My next session will be next Tuesday, technical analysis focused more at 6 p.m. UK time. All right, everybody. Bye for now. Good luck with the trading.